in quite an environment to have a conversation with you, Jeremy. Welcome back to F.A.C.E.
Thanks for having me, Dale. Good to talk to you. Good to hear all the views on FX markets right before this.
Yeah, FX is the deepest market, and most of the time you don't hear about it, but we started to get some talk about multinationals saying it was a headwind, and these moves in the dollar are historic, what we're looking at here. So, Jeremy, I know you're with Wisdom Tree. Did you want to show some charts today, or just talk with me?
Can I share my screen, or is that
Yeah,
or do you need
definitely.
To your screen?
Yeah.
So I'll pull up my website, which I do have some stuff, and then maybe we can come back to your guys' charts and
No, well, just you can share your screen by scrolling at the bottom of the box.
Okay.
I know we weren't even using Zoom the last time you and I talked, so it was still GoToMeeting. That was 5 years ago, I think.
Here we go.
Yeah, you're up.
All right. So this is the Wisdom Tree website. We have some great tools as well. We're ETF company. I've been global CIO. I've been with Wisdom Tree 17 years, so one of the regional employees from the firm. I've worked with Jeremy Siegel now for 21 years. Actually, today, it's an interesting day, Dale, to be on. Our new edition of Stocks for Long Run is out on Amazon. I've been working with him for 20 years, but this is the first time we're co-authors together on the book. So
congratulations.
Exciting for that. So give that a shout. But
he was a little apoplectic the other day on CNBC, wasn't he?
Yes. So he made some headlines, and I've been tweeting out to this. So I might as well show, one of the key things, and this is a chart from the book.
He's too valuable to have his blood pressure go up that far, Jeremy.
I know.
We need him around, so we.
So I'll do a quick thing on the money supply and inflation, why he's all fired up. But this is a chart we show in the book that the long-term trend in money supply was growing 5% a year, and it should grow at 5% a year, which is the money supply translates to real growth in the economy and inflation. So if you think real growth in the economy is 2 to 3% and inflation is 2 to 3%, you should have the money supply grow at a trend of 5%. And so when in the pandemic response, you saw this 5% shoot up 17.5% in 3 to 4 months. This is when he was really starting to be vocal, saying, you're going to start to see inflation. He was on, we do a weekly radio show, so he was telling me that on the show. He was on Barry Ritholtz's podcast, sort of well documented in June of 2020, talking about it. So 2 years ago, obviously. And then, if you go to the long term, the 70s and 80s, the CPI was 7% a year, money supply was 9.6. You see in the sort of last 40 years, CPI was 2.5 when money supply was 5. So this goes back to the money supply being 5. And then you scroll down, this is a key data point today, the money supply today, the 4-month change has printed negative. So you almost never have the money supply print negative. Very, very rare. So you saw the post-pandemic response. You see now the 4-month change. So this is going to be the key data you get today. So look at 1 p.m. It's likely to continue to show declines. This is why he says they need to, they don't need to do any more really. But
wasn't there a problem with velocity even before the tapering?
Yeah, I mean that is the sort of formal equation that MV equals PY. So the money supply times velocity is prices times real output. And so there was a declining velocity, but this
exacerbated it.
Yeah, there's this whole question about why is money supply really an indicator? Powell is denying it's an indicator, and we can come back to that. In terms of this big story, and since you guys are focused on currencies, I thought I would pull up, in the ETF world, we do have two baskets. So that's sort of the DXY index. We have a Bloomberg dollar index called USDU, which is a little bit more broader. The DXY is about over 50% euro. This has a little bit less euro, a little bit more everything else. And has a little bit of EM, but not dramatically EM. And the point I was going to make on this, and it ties into sort of Fed versus emerging markets. You were talking about the RAND for a little bit. So this is the longer term chart on the dollar versus EM, but pull into the year-to-date chart, and what you see is, USDU is up about 14.4. CEW is a basket that's only down, I say only, but down half, down 6.8, which is a testament to these central bankers taking the medicine early. One of the things you could see, there's a field called embedded income yield on our fund pages, and we're using forward contracts to get these currencies. So it's sort of the relative interest rate differential between the Fed and these sort of foreign central banks, and the embedded income yield today, is about 1.6. Could have been higher as the Fed was raising rates, but again, you're getting some catch up in the rest of the world. In CEW, the embedded income yield is your long EM currencies versus the dollar, and yes, the Fed's hiking, but you have a 9% embedded income yield. And that's obviously some extreme yields in some of these other countries. Just show the set of countries you're in.
Is it the higher the yield, the higher the risk?
For sure. You've got Brazil, you've got Chile, you've got all these different currencies. But so that, I think it's just an interesting reflection of, you tend to think of what's happening in the pound as, a lot of people were saying this is like an emerging market currency status. The developed are the new EMs, is my sort of buzz line, that
interesting.
The EM currencies are holding up better. The EM currencies are holding up better, half the declines as the developed currencies, because they raised rates sooner, and you get, again, that 9% embedded income yields versus the dollar on an average basis.
Let me ask you this, Jeremy. Were you around long enough to remember things like the Plaza Accord, et cetera?
I mean, I wasn't trading, or I wasn't that wasn't my time, but I heard a lot about it.
Well, BOJ cracked the ice with their intervention last week, right? And we don't know. They're saying there was no intervention in the BOE on the pound collapse. But don't you think we're getting to the point to where it'd be an easy card for the Fed to play, because it's easier to depreciate your currency than to appreciate it? That there would be some type of deal between some central banks for a concerted intervention?
That it wouldn't be in the Fed's interest, though, in many ways. I mean, it'd be in Japan.
Right.
The strong dollar is helping our inflation problems, which is making inflation easier on us. I've been saying, and I've been a big proponent of currency hedging for the developed world. I'm going to just pull up a few more charts on my website to show you a few things on Japan versus, hedged, unhedged.
I mean, why would I want to buy emerging market currencies if I thought this dollar bull run was ad infinitum and continuing to get parabolic to the upside, even though they're holding up better? Don't you need a dollar turn for that really to work?
Yes, and I agree with that. I was just saying, you get a nice embedded income yield. It's just a different dynamic.
The yield is interesting. So so the yield's interesting, especially even though treasuries have come back to 4%, it's twice that. So what do you think here?
So this is, you talk Japan, so I've been a big proponent for the last 10 years, really, that people should be doing currency hedging when they buy overseas stocks way more than they are. And Japan was a hit product in 2013, 2015. Then people lost interest in the trade. Look what's happening this year. The S&P down 21%, EWJ unhedged Japan down more, down 24. DXJ currency hedged Japan up 4%. Like, what in the world is going on there? Well, it's partly it's dividends. So we incorporate dividends at Wisdom Tree, and so it's more of a value tilt. So
and we were short the yen.
Well, we're neutral to yen. So we don't. So when you're currency hedged, that is the big story. People say DXJ is long the stock, short the yen. It's short the yen relative to EWJ, because EWJ actually is long the yen. They're long the yen and long the stocks. We're just neutral. We're basically just saying, you want Japanese stocks, we've dividend-based Japanese stocks, no yen impact. Now there's a carry trade because Japan has negative rates still, and so we're earning the positive carry too. And obviously you didn't really have much positive carry in the first 9 months, but going forward, we have about a 4% positive carry. Not, maybe not quite, but you're earning that carry. So the unhedged has to catch up to break even, with that. And so I've been saying people should do this strategically. That they should be much more currency hedged. The dollars had this strong negative correlation between the dollar. Let me pull up that chart because that was a pretty cool piece I also wrote recently on the negative correlation of the dollar to the S&P, and it talks like why, if you're investing overseas, it sort of doesn't make sense to me to speculate on these currencies.
Right. Yeah. God, it's never been more important. Either direction. If the dollar was in a bear market, you still need to know what currency you would have exposure with and which you'd have less. So your view on all the bearishness in the market here, Jeremy?
Well, it's hard for me to have a different tone than the professor. I'm actually in the lead story of the Wall Street Journal today saying we're worried about the Fed over hiking more than necessary was sort of the quote that they're being too aggressive given that money supply dynamics, given all you showed copper coming down 40% from their highs, oil coming down from their highs, the mortgage market at 6.5% to 7%. Real estate is going to come down. There's no question real estate is going to come down, even though CPI is continuing to show real estate prices rising. So that the over hawkishness from the Fed is tough to turn back from. There's a lot of commentary. If they just paused, you're going to get this, that'll be counterproductive to their narrative. It'll lead to more inflation. But real rates
maybe that wouldn't be. You know what? Let me push back. Maybe that wouldn't be counter to their agenda, because if inflation, which we've been exporting, and the dollar weakens, and we bring some of that back while we give Europe some relief, that would keep prices up, right? Which would be good cover for them to say they want to keep tightening and continue their policy.
It definitely could help the European situation.
It could help the whole globe.
Oh, for sure. I mean, I think there's a lot of truth to that.
So, I mean, don't you think it's a card that I know it's not the Fed's purview on the dollar. I mean, Yellen would have to come out and say something, and it would be under her direction, right? But it seems like an easy card for central planners to use right in here.
Yeah,
just intuition here, Jeremy, because things have gotten disorderly. I mean, we can't walk away from what's happened in the last week or so in currency markets, and the markets could live with it, but business can't.
The thing that I think, if one of Japan is the center of, there's a lot of people at the center of the storm, but Japan is one that's a notable outlier that they're trying to intervene, but they're not changing their policy. So like, if they actually want to have an impact, they need to stop the yield curve control, stop pegging the 10-year at 25 basis points, and let it float with the global interest rates. They don't want to do that. And that's what's pressuring the yen. But they were the highest debt to GDP forever, and people were saying, well, highest debt to GDP, but the lowest interest rates. I mean, that's sort of the fear we have in the U.S. and around the world, is that all this debt's going to lead to much higher interest rates and borrowing. But Japan was the exact opposite, and you wondered why the yen wasn't weaker and why it could hold up despite the Bank of Japan buying all the bonds. And maybe that risk just built up, and that's naturally what you're seeing. And they know there's not much they can do about it. But until they change policy, it's hard to see the yen pressure weaken. I think they're going to have to keep intervening. I don't think it's going to be effective.
Not if it's just them,
right? Or if they're changing the policy. I don't think the limited interventions is meaningful unless they change those fundamental forces.
Okay. Well, I think the G20's meeting in early October. I don't know if they, maybe market forces will create this correction in the dollar. I think it might take cooperation and something concerted by central banks together to do something. But, like everything, time will tell. How about bonds? at these levels, are you seeing some money flow that want to go in and lock up some of these yields in
You're
your
definitely
ETFs?
so for sure, our top flowing ETF has been USFR. It's floating rate treasuries. People were going to bank loans for the floating rates, but with the government issued these treasuries in 2014, we've seen about 6 to 7 billion come into our floating rate treasury product, and it has 1 week duration, so it's been the fund that's floated with the Fed,
Okay.
and so I think that's the opposite of duration. That's sort of the shortest duration. We are seeing more conversations around, you're hearing Tina's is done, and you got Terra, that there's now a real alternative. We are talking about in our own, we do a model portfolio business where we're helping be sort of an OCIO type role for advisors. We are having our own conversations. We've been short the benchmark on duration. We're talking more about it. I think our technical people have said 414 is one of the Fibonacci levels that goes back 15 years. That if you really still continue to see more path
for the 10-year.
Yeah, for the 10-year.
Okay.
I'd say the real rate move. You started the year with real rates in negative territory. The 10-year tips being negative 1%. You've had over 200 basis points move in that 10-year. You got to like 1.4. I don't have the exact quote in front of me now where we are in the 10-year tips, but as you get 1.5 to 2% from a long-term basis, those real yields we think are above where their long-term rates are. So I would say they're getting more attractive, and that there is a real alternative there that you can start to earn real income on, and so I do think it's starting to pay to add a little bit more, or at least not be a short duration as we were versus our benchmarks. That's a live conversation we're happening. But the technicals, the technician guys would say you could still have more room for upside. And again, you still haven't seen Japan do anything yet. And so Japan could be one of the other catalysts for even further, movements and rates higher.
Okay. And S&Ps, I don't know if you could see my chart. Sure looks like Wile E. Coyote is standing on the ledge here, and we'll see how long it holds. Should get, what do you think? Are we going to finally have that capitulation that never showed up in maybe a volatility products that people trade instead of, do you have anything that people are moving into because of this advance in VIX? It's been pretty disappointing throughout the first 10 months of the bear market because we've had intense moves, but it hasn't been reflected in the VIX till maybe now.
Yeah, and you can say, why is vol compressed? Is it going to get to that 40 level of capitulation? I think so much of the market has been dictated by the bond market. The move index vol was one that was where you saw some of that capitulation. But and now there's also been a ton of option selling programs. I think one of the most successful new ETF lineups has been option-oriented ETFs that's selling calls. So I think that could be one of the things that compresses VIX more structurally. And so perhaps you don't get as high as you did. But yeah, no, I think that we've been talking about that is like, you'd like to see that 40 to 50 VIX real capitulation sell-off, but you haven't seen it. And so I think, it's still all a rates move in my view. Like even what's happening in crypto, it all comes back to like what's happening in rates driving the sentiment and driving the pressure, and so it's all correlated. It's all the same trade in so many different ways. And so
do you guys have crypto products? Because it was interesting yesterday, Bitcoin was up with everything else in the red. They're saying it's a crypto winter, so I'd assume there aren't a lot of people, if you have ETFs in Bitcoin.
In Europe,
that's probably slow.
In Europe, they do. In the U.S., the regulators have been slow allowing that type of product in the U.S. But in the European markets, they do have what's called ETPs for Bitcoin, Ether, baskets of crypto. We've seen some interest, but certainly modest. We're definitely having ongoing good conversations with clients, and there's some large family offices who have been watching it. And and exploring. So I think there is some, there's definitely high engagement around the topic for sure.
Okay. Well, I mean, they're saying calling it the crypto winter. Isn't there an old Wall Street expression? Buy straw hats in winter. I bet I bet Jeremy I bet he remembers that saying. Buy straw hats in winter. So
yeah,
it's winter, right? In crypto.
Go. There you go.
All right. So very interesting, Jeremy, on your funds that take advantage of currency moves instead of only hedging it, but it actually enhances the ETF with yield. So
exactly.
What's the best way for people to, maybe talk to you about it that might be interested in some of the ETFs you mentioned today on the broadcast?
So I showed my Twitter profile, Jeremy D. Schwartz. You can follow me there, send me direct messages if you want to find me there. We also, as you're showing on the website, there's a blog, daily commentary. There's on that strategies page, there's a ton of great content. We have some dashboards. If you go to On the Markets, the top one, the very top link, there's a daily dashboard that gives some of our market charts and views of all that's going on as the top link. The Siegel commentary is there. We get weekly commentary from the professor if you want to stay up to date with him. So you see that the daily market snapshot, you see the weekly market commentary. We're doing a bunch of stuff here. So the On the Markets and then the Insights blogs above also has some other daily commentary. So you could find us. We do office hours similar to this format. We're doing a bunch of those as well. So you can tune into our content there.
What a great place for intelligence gathering. Really, it was great. It was great talking to you again, Jeremy. Let's keep in touch and touch base in the winter, and maybe by this winter it'll be a crypto spring, and the dollar will be a different story. So really appreciate your giving spirit and coming here, and some very interesting ETFs that you guys have. Appreciate the quality of your work, Jeremy.
Thank you so much for having me.
All right, so that's a wrap, everyone. Jeremy Schwartz, follow him on Twitter at Jeremy D. Schwartz, and go to Wisdom Tree and check out his writings. Dr. Siegel is, let's face it, he's an important voice in the financial markets nowadays, and important to know what they're thinking. So you could join the team in 15 minutes. We'll make it 18 on the Morning Edge. And above all, my friends, my trading warrior brothers and sisters, good hunting today. And remember, don't just count your pips, count your blessings. Adios. And go join the guys in the chat room, because I know there's action happening there right now. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.